Something unusual just happened in the world's largest gold markets. In India, premiums that were sitting at decade highs suddenly collapsed, almost overnight. In China, buyers stepped in quietly, just as global prices pulled back from record levels. Two major economies, two completely different reactions. Is this simple market volatility, or a deeper signal about shifting capital flows? When one market hesitates and another accumulates, history suggests liquidity is moving with intention. And when gold begins to behave differently across Asia, it rarely remains a local story. It becomes a warning. Welcome to Boring Currency Index, where markets are observed calmly, but never casually. If you believe experience matters more than noise, especially those watching who have seen multiple economic cycles, consider subscribing, because preparation has always favored the informed. And let us know in the comments, where are you watching from today? In India, the gold market delivered a sharp reminder of how quickly sentiment can change. Premiums that had surged to around 153 per ounce above official prices dropped to nearly half that level within days. The sudden fall reflected more than price movement. It reflected uncertainty. Buyers struggled to understand rapid swings in domestic gold prices. After touching record highs above 180,000 rupees per 10 grams, prices corrected sharply. When volatility increases, confidence often decreases. Many customers delayed purchases, unsure whether prices would stabilize or fall further. The earlier rise in premiums had been fueled by expectations that import duties might increase in the national budget. When the government left the duty structure unchanged, speculative pressure disappeared. Demand softened quickly. For business observers, the message was clear. Even strong markets can weaken when expectations shift. Volatility affects psychology first, and demand second. While India stepped back in confusion, China moved with calculation. As global gold prices pulled away from record highs, Chinese buyers did not panic. Instead, they leaned in. Premiums in China rose slightly, signaling steady physical demand even during a broader correction. This difference was not accidental. In China, gold is not only a symbol of celebration, it is a tool of protection. When prices fall after sharp rallies, many consumers see opportunity rather than risk. They view pullbacks as entry points. Ahead of the Lunar New Year, seasonal demand naturally increases. Families purchase jewelry as gifts. But this time, another force was visible. Investment demand remained strong. Bars and coins continued to attract buyers who were focused less on decoration and more on wealth preservation. Recent data showed that overall gold consumption in China had declined for 2 consecutive years. Yet, within that decline, something important changed. Purchases of bars and coins overtook jewelry demand. This shift suggested a mindset transition from consumption to capital defense. Dealers observed that buyers responded positively when prices corrected. Instead of waiting in uncertainty, many acted quickly. They believed that long-term risks in the global economy still existed. For them, gold represented stability. For entrepreneurs and investors, this contrast carried a message. Markets do not react uniformly to volatility. Some retreat, others accumulate. China's response showed that confidence in gold as a store of value remained strong. And when investment demand grows quietly during corrections, it often signals deeper concerns beneath the surface of the global economy. Just days before one of Asia's most important festivals, the gold market reset itself. Global spot prices fell more than 13% from record highs. For many traders, it looked like a technical correction. Charts cooled, momentum slowed, speculators reduced positions. But beneath the surface, something more strategic was happening. The timing mattered. The pullback came just before the Lunar New Year, a period when physical demand across parts of Asia traditionally rises. Instead of entering the holiday season at overheated price levels, the market experienced a controlled decline. Analysts described it as a healthy adjustment. It reduced pressure, it restored balance. In financial markets, corrections often separate speculation from conviction. Short-term traders exit quickly. Long-term buyers begin to evaluate value. This shift was visible across Asian hubs. In Hong Kong, premiums remained modest. In Japan, bullion traded at slight discounts before returning to small premiums. In Singapore, prices moved within a narrow range. These variations showed how liquidity flows differently across regions during volatility. The contrast between futures markets and physical markets became clearer. While paper prices fell sharply, physical demand in key centers remained resilient. This divergence suggested that the correction did not erase underlying demand. It only adjusted excess momentum. For business observers, the lesson was important. Corrections do not always signal weakness. Sometimes they prepare the ground for stronger accumulation. The gold market's reset before a major seasonal demand cycle was not random. It reflected how global liquidity recalibrates itself under pressure. And when markets stabilize after sharp declines, it often signals that deeper forces are still at work. For For serious decision makers, this was never just a story about gold premiums. When India's premiums collapsed, it revealed how quickly sentiment can shift in a price-sensitive economy. Expectations alone had pushed premiums to extreme levels. Once those expectations failed, the market corrected sharply. This showed how fragile short-term demand can be when driven by speculation rather than stability. At the same time, China's steady appetite during the correction told a different story. Buyers there acted with long-term intent. They treated lower prices as opportunity. This difference between hesitation and accumulation reflected two distinct economic mindsets. For entrepreneurs and investors, the message was strategic. Gold often acts as a confidence indicator. When physical demand weakens suddenly, it can point to liquidity stress or consumer caution. When demand strengthens during price declines, it often signals underlying concern about future economic risks. Business leaders must understand this contrast. Volatility is not only about price risk, it is about behavioral risk. It affects inventory planning, cash flow management, and capital allocation decisions. The shift from jewelry-driven demand toward bar and coin purchases also carries weight. It suggests that more buyers are thinking about preservation, not celebration. That change in motivation can influence long-term market structure. In uncertain times, commodities become economic signals. They reflect trust, fear, and preparation. India's premium collapse and China's steady demand together form a warning pattern. For those building businesses or managing capital, ignoring such signals can be costly. Because when physical markets start behaving differently across major economies, it often means that larger financial adjustments may already be underway.